Coca-Cola versus Pepsi. It's one of the oldest rivalries in business, and honestly, it's one I have been curious about for a long time. Both companies have been rewarding shareholders with dividends for decades. Both are household names. Both feel like the kind of stocks you could hold forever. But if you're building a dividend portfolio and you can only pick one, then which one is better? That's exactly what we're going to talk through today. We're going to look at dividend yield, dividend growth, how long each company has been raising its dividend, and what the total return picture looks like over time. By the end, you'll have a clear view of what each stock brings to the table, and you can make the call that fits your own investing goals. Please remember, this is not investment advice. Always do your own research before making any financial decisions. Let's start with Coca-Cola, because for a lot of dividend investors, this is the gold standard. When people think of a reliable, boring, beautiful dividend stock, this is usually what they picture. But before we get into the numbers, it's worth spending a moment on what Coca-Cola actually is as a business, because it's genuinely one of the most elegant business models in the world. Coca-Cola doesn't manufacture most of the drinks you buy. What they do is produce the concentrate, the syrup, and then sell that to a network of bottling partners around the world who add the water and carbonation, bottle it, and distribute it. That means Coca-Cola is able to generate enormous amounts of free cash flow. That free cash flow is ultimately what funds the dividend. The brand portfolio is staggering. Outside of just Coca-Cola, the company also owns Coke Zero, Diet Coke, Sprite, Fanta, Schweppes, Minute Maid, Powerade, Dasani, Smartwater, Innocent Juices, Fairlife milk products, and hundreds of regional brands most people outside those markets have never heard of. In total, Coca-Cola operates in over 200 countries and territories and sells over 2.2 billion servings every day. The repeat purchase of Coca-Cola drinks is one of the key ingredients for a successful dividend-paying stock. Its customers are usually loyal, so the demand remains resilient throughout both good times and recessions. Coca-Cola's current dividend yield sits at 2.72%. That's a solid yield, especially when you consider the quality of the business behind it. Now, yield on its own only tells you so much. What really matters for a dividend investor is growth. Is the company consistently raising that dividend over time? And with Coca-Cola, the answer is a very firm yes. They've raised their dividend for 64 consecutive years. That makes them a dividend king, a company that has raised its dividend for at least 50 years in a row. That's an extraordinary track record that very few companies in the world can match. To put that streak in context, Coca-Cola was raising its dividend during every major global crisis in recent history. Every single year, they found a way to put more money in shareholders' pockets. That consistency is rare, and for a dividend investor, it's genuinely valuable. In terms of how quickly that dividend has actually grown, the 10-year dividend growth CAGR for KO comes in at 4.24%. That's a steady, consistent growth, which has historically kept pace with or slightly ahead of inflation. For income investors who are counting on that dividend to maintain its purchasing power over time, that matters. And then there's the total return question, because dividends are only part of the story. Over the last 10 years, Coca-Cola has delivered a total return of 140% with dividends reinvested. Stretch that out to 30 years, and it rises to 690%. That's the power of compounding through a business that just keeps quietly delivering year after year. There is one genuine question mark hanging over Coca-Cola's long-term future, and it would be dishonest not to address it. The world is becoming more health-conscious. Younger consumers in particular are increasingly scrutinizing sugar content, moving toward water, functional drinks, and lower-calorie options. Classic Coca-Cola is not exactly the poster child for healthy living. And that's a real consideration for anyone thinking about holding this stock for the next 20 or 30 years. The good news is that Coca-Cola has been aware of this shift for a long time and has been actively managing it. Coke Zero and Diet Coke have been major pillars of their strategy to retain consumers who want the taste without the sugar. They've expanded aggressively into water with Dasani and Smart Water, into juices with Minute Maid and Innocent, into dairy with Fairlife, and they've been quietly building out a broader portfolio of better-for-you options. The company has also been trimming its brand portfolio, cutting underperforming products to focus resources on the brands that are actually growing. So while the health trend is a real headwind for sugary drinks specifically, Coca-Cola's response has been to diversify its own portfolio rather than simply defend its core product. Whether that's enough to sustain the growth rates of the past is a fair question, but the business has shown it can evolve, and its distribution network is so deeply embedded globally that launching new products through that system is something very few competitors can match. Now let's look at PepsiCo. And this is where things get interesting because PepsiCo has a different business to Coca-Cola, even though people often lump them together. The single biggest distinction is that PepsiCo is not primarily a drinks company. It's a food and beverage company, and has been for many years. The food side has actually been the larger and faster-growing part of the business. When you buy a bag of Lay's, a bag of Doritos, a packet of Walker's Crisps, a Quaker Oat bar, or a bag of Cheetos, that's PepsiCo. When you reach for a Gatorade after the gym, that's PepsiCo. When you grab a Tropicana orange juice at the airport, that's PepsiCo. When you drink a Mountain Dew or a Pepsi Max, yes, also PepsiCo. The brand list is enormous. It's a genuinely vast portfolio spread across snacking and beverages. And what that means in practice is that PepsiCo's revenue is more diversified than Coca-Cola's. If there's a particular headwind hitting the carbonated drinks market, PepsiCo has an enormous snacks business helping to carry the load. That's not a trivial advantage. It means the earnings base is built on multiple pillars rather than one. Now, the flip side of that is that PepsiCo is also a more operationally complex business. There are more moving parts, more supply chain exposure, and higher capital requirements. Coca-Cola's model is arguably leaner. But for a long-term dividend investor, the diversification PepsiCo offers is genuinely appealing. PepsiCo's current dividend yield is 3.55%. So right off the bat, you're getting meaningfully more income from PepsiCo at today's price. Almost a full percentage point more than Coca-Cola. On dividend growth streak, PepsiCo has raised its dividend for 54 consecutive years, also a dividend king. So both companies carry that elite status, which tells you something about the culture of shareholder returns at both businesses. Like Coca-Cola, PepsiCo has been raising its dividend through recessions, market crashes, and global crises without missing a beat. PepsiCo's 10-year dividend growth CAGR comes in at 7.3%. This is one of the more meaningful differences between the two stocks. PepsiCo has been growing its dividend at nearly double the rate of Coca-Cola over the last decade. If you're an investor who prioritizes dividend growth over current income, someone who's happy to accept that their yield today is less important than how large their income stream becomes in 10 or 15 years, that number really stands out. On total return, over the last 10 years, PepsiCo has returned 120% with dividends reinvested, and over 30 years that figure rises to 612%. The health consciousness shift affects PepsiCo too, but in a slightly different way. On the drinks side, the same pressures apply. Sugary sodas are under scrutiny, and younger consumers are drifting toward healthier options. PepsiCo has responded in a similar way to Coke, leaning into Pepsi Max and zero sugar variants. And Gatorade has been evolving its product line to include lower sugar options through Gatorade Zero. But where it gets more complicated for PepsiCo is on the snack side. Crisps, Doritos, and Cheetos are not health foods, and nobody really pretends otherwise. The question is whether people will actually stop buying them. And the honest answer, at least so far, is not really. Snacking has proven to be remarkably resilient. People cut back on restaurant meals in tough times, they trade down on big purchases, but they still grab a bag of crisps. In many ways, snacks share the same affordable treat dynamic as a can of Coke. PepsiCo has also been making genuine moves into healthier snacking, expanding Quaker's presence, developing lower-calorie snack options, and investing in brands that align better with modern consumer preferences. It's a longer journey for a company whose biggest brands are inherently indulgent, but the diversification of the portfolio actually gives them more levers to pull than a pure-play drinks company. So let's put the two side by side and make sense of what the numbers actually mean for your portfolio. On yield, PepsiCo wins clearly. At 3.55% versus Coca-Cola's 2.72%, you're getting almost a full percentage point more income from PepsiCo at today's prices. For investors who are looking for higher income today, that matters. On dividend growth rate, PepsiCo wins again, and it's not particularly close. A 10-year CAGR of 7.3% compared to 4.24% is a substantial difference when you compound it over time. If PepsiCo continues growing its dividend at that pace, investors who bought today will be sitting on a much larger income stream a decade from now than their Coca-Cola counterparts. Both are dividend kings, both are exceptional, and both will likely do anything they can to keep their dividend increases going. Interestingly, despite PepsiCo's higher yield and faster dividend growth, Coca-Cola has actually outperformed on total return because of higher price appreciation. Over 10 years, KO returned 140% versus Pepsi, 120%. Over 30 years, KO returned 690% versus Pepsi, 612%. If total returns are important to you, this is worth taking a note of, but as a buy and hold dividend stock, the small difference in total returns is, in my opinion, not a deal breaker. So which one is right for you? Here's the honest answer. Both of these stocks are excellent. If someone told me their portfolio held both KO and Pep, I wouldn't argue with them for a second. These are two of the most reliable dividend payers in the world. But if you could only keep one, I would argue PepsiCo is a better choice, at least for me. I value the greater diversification with exposure to both beverages and snacks, the higher starting yield, and the higher dividend growth. Both are good choices, and a personal preference may play a role here too. Which one is your favorite one? Do you have one or both of these stocks in your portfolio? Let me know in the comments. Thank you for watching until the end. I hope you have enjoyed the video. If you have any questions, please put them in the comments section and I will do my best to answer them. See you next time.